Bitcoin versus Ethereum, a tale of two markets. Why crypto mirrors the bond stock divide. Flint West reporting. Let's get something straight before we start throwing tickers at each other. Bitcoin and Ethereum are not fighting for the same job. They're not even applying to the same department. Yet every cycle, we line them up like heavyweight boxers and ask, which one wins? Market cap this, flippening that. As if capital doesn't have a memory. As if money doesn't have instincts. It does. And those instincts are older than crypto, older than markets, older than the charts you refresh every morning. They're the same instincts that built the bond market. Here's the uncomfortable truth. Most money doesn't want to be clever. It wants to be safe. It wants to sit still. It wants to survive. That's why, for decades, the bond market quietly dwarfed the stock market. Not because bonds are exciting, but because they're boring on purpose. Pensions, sovereigns, insurance pools, corporate treasuries, capital that doesn't get applause for taking risk, it gets fired for losing money. That's not speculative capital. That's preservation capital. And this is where Bitcoin enters the room. Bitcoin didn't show up to build apps. It didn't show up to host games or NFTs or DeFi dashboards. It showed up to answer one question. Where do you store value when trust starts leaking out of everything else? Fixed supply. No committee. No roadmap drama. No competitors left standing. The store of value race is over. Thousands tried. One survived. That's not a startup story. That's a monetary event. Bitcoin behaves less like a tech stock and more like a sovereign instrument. Volatile early, yes, but structurally singular. Like bonds were volatile once too, before they became furniture. Now look at Ethereum. Ethereum is brilliant, but Ethereum is busy. It's a platform, a factory, an economy under construction. And platforms compete. Ethereum competes with Solana, with future architectures we haven't named yet, with stablecoin native chains, with regulatory shifts, with design trade-offs. That's not a flaw. That's the nature of productive capital. Stocks behave this way too. They grow, they innovate, they rotate leadership, they fragment, they consolidate. Some win big, most don't. Ethereum doesn't need to lose for this to be true. It just needs to remain what it already is, a risk-bearing engine for deploying capital. That makes it powerful. It also makes it uncertain. So when people ask, will Ethereum flip Bitcoin? They're asking the wrong question. The better question is, why do we expect the market for building things to be bigger than the market for protecting wealth? Historically, it isn't. Real estate outweighs equities. Bonds outweigh stocks. Money outweighs venture. Because before capital builds, it hides. Before it risks, it secures. Before it speculates, it survives. This isn't maximalism, it's market structure. Bitcoin maps to the bond market, large, conservative, winner-take-most, and obsessed with durability. Ethereum maps to the stock market, dynamic, competitive, innovative, and permanently unsettled. Different roles, different risk profiles, different ceilings. And once you see it that way, the debate changes. Not who wins, but what job each one is doing. One secures the value of time, the other deploys it. And history has been very clear about which pile of money gets bigger first. That's not an opinion. That's how capital behaves when the noise fades. Flint West, signing off.